Guys, there's been a lot of news made recently about Michael Burry's short on ARK Funds, Cathie Wood's main fund. In fact, so much news was made that Cathie Wood was forced to clap back and say that Michael Burry doesn't know what he's doing. Yes, you heard it right. Cathie Wood said that the guy who they made a movie on, The Big Short, doesn't know how to invest in this environment in her particular names. Now, I'm not smart enough to tell you who's right or who's wrong. Pick your fighter. But what I can tell you is that everyone is missing the one huge announcement in Michael Burry's latest release. Burry has made a huge bet on pharmaceuticals distribution. And for the astute viewers out there, you guys know that that's exactly what we went heavy on this channel. So Michael Burry just gave our research a big nod because we're thinking in the same way that he is, in that pharmaceuticals are a big opportunity right now based on the valuations. And we're gonna dig right into that. You're watching More Money? Let's get it. What's up, everyone? Thanks so much for tuning in. You're watching the #1 channel on YouTube for people that want to retire early. Now let's get right into it. If you guys missed this huge news, don't worry, I did too. There's been so much news on Michael Burry shorting Tesla and the 20-year Treasury bond ETF that everyone has missed the context in the ARK short. If you combine the value of the Tesla and the TLT positions, it's over $1 billion. So when people are making all this news about Michael Burry shorting ARK, we have to take into account that it's a relatively small amount of only $31 million of Michael Burry's portfolio. So I don't even know if this should be registering. It's definitely not as newsworthy as it's been made out to be. But materiality doesn't really matter with the media, just what gets clicks and views. So I understand why they're talking about it. They're really pitting Michael Burry against Cathie Wood. I get it. Now, the one item that is newsworthy, at least for stock pickers, that everyone is ignoring, is that Michael Burry bought call options on Cardinal Health and McKesson Corporation. His position in these two names is approximately $200 million. So this is a material position for one of the smartest minds in finance. In other words, Michael Burry is making a big and aggressive bet on the pharmaceuticals distribution segment. And if you've been keeping track of this channel, we highlighted Cardinal Health just a few weeks ago. So I'm personally in a very good position to understand why Michael Burry is so bullish on these stocks, as I've done the deepest of dives that you can find on this channel. And I have to thank some of you guys, as some of you are starting to notice how diligent the research is on this channel. I love how some of you call this channel a gem on YouTube, and even the super nice Jamie Bortero has gone so far as calling me the GOAT of due diligence. That's honestly super humbling. If you think the work on this channel is good, please reward me by hitting a like on this video. That's all I really ask. Also, if you're new, please consider subscribing. There's lots of good research coming out, 2 videos a week at least. Okay, so what are the main reasons why Michael Burry is so bullish on the pharmaceuticals distribution space? I have 2 very good reasons why these companies would be part of Michael Burry's portfolio. The first, and I believe the most important reason, is that these companies are a hedge on inflation. It's well documented that Michael Burry is expecting inflation, so if he's going to be bullish on anything, it will be on a company that is a sustainable long-term inflation hedge. You can see that his portfolio does consist of call options on Facebook and Google, 2 great long-term hedges on inflation. I used to own Facebook, but if you've been following this channel, I did mention that the valuation has gotten rich, so I ended up closing my position in it. You can actually download the Facebook model and see my valuation on it. I also think Google is a bit expensive despite being a super bull on the Google Cloud segment and the YouTube segment. In my Google model, I'm growing both segments at 30% a year, which is absolutely amazing for a company like Google to still continue to be able to do. You can find that Google series in the description below, as well as you can grab the model from the description below. Okay, so how is Google and Facebook similar in any way to pharmaceutical distribution? One is a technology innovator which is changing the world, and the other is an old and boring pharma distributor. You can tell it all has to do with pricing power. We know that Facebook and Google have pricing power. And similarly, if prices continue to increase, the one area where we will not cut back is on our pharmaceuticals. The additional costs will get passed on to the customers, and we as consumers will gladly accept the costs. Our health is too important. In a single payer market like I am in Canada, our government-sponsored healthcare providers have no option but to accept these higher costs. As I mentioned in the Cardinal Health series, these companies exist to bring down the cost of getting pharmaceuticals and hospital products to the right place at the right time and at the right price. These companies are enormously important, which is why if you type in the largest healthcare companies, the pharmaceutical distribution companies take over the top 8 businesses. High inflation, wars, banking crises, 9/11, it doesn't matter. These businesses are not going anywhere. There is no technological advancements that I can personally think of that will take these businesses out anytime soon. So they are absolutely long-term and sustainable inflation hedges, just like Google and Facebook, and was a key reason as to why I made Cardinal Health over 10% of my portfolio. Now, the second reason why I think Michael Burry is investing in these pharmaceutical distributors is because I believe that the decline is overdone. Burry is betting on pharmaceutical distributors because their valuations are now so low. This is the opposite problem that I'm personally having with Facebook and Google. Despite these companies being absolutely phenomenal companies, the problem I'm having is that their valuations are really high relative to what I feel their intrinsic values are. I'm just not getting a margin of safety when I'm buying these stocks. This isn't the case with the pharmaceutical distribution companies. As I went over in the Cardinal Health series, the share prices of these companies have been beat up due to the negative press surrounding the opioid lawsuits. And I don't really understand why, because they've told us what the ultimate liability is expected to be, and in their financial statements, they have booked the top end of that liability. So when we value these companies, all we have to do is deduct the per share value of these potential opioid lawsuits, which amounts to approximately $13 a share for Cardinal Health. So despite the reduction in the valuation by approximately $13 a share, the intrinsic value of Cardinal Health shares are still valued at approximately $87 per share. Download my model and take a look for yourself. And I'm not even forecasting a huge PE multiple expansion. This valuation reflects a very low multiple of 11 times free cash flow per share, and the add back of the cash on the balance sheet, which effectively nets out the opioid liability. As I mentioned in the Cardinal Health series, the share price being at $50 a share reflects a 13% free cash flow yield, and if you add in a 5% annual growth rate, it gives you an approximate 18% annual return on this investment. Now, is this a blowout investment? Is it going to triple and go to the moon? Absolutely not, but it makes a lot of sense to be in Michael Burry's portfolio. It also makes a lot of sense to be in my portfolio. I'm not finding a lot of opportunities out there, so if I can find something in this market which is giving me approximately 18% a year, I'll take it. Now, if you haven't checked out the Cardinal Health series, please check it out on this channel. I didn't really do one on McKesson because it's largely the same thing. I understand why Burry went with McKesson more, as it is the cheaper of the two, but I chose Cardinal Health because I believe that they are the operationally stronger of the two. But we're just playing semantics here, and investment in either will likely yield similar results. I'm sure Michael Burry is more right than I am, but I just go with what I'm comfortable with. Also, guys, please don't forget to smash that like button. And if you haven't yet, please consider subscribing to the channel. I really feel like we're doing something very unique on this channel with unbiased, zero hype, deep dives into the fundamentals of many of the most popular securities out there. I also make all the models available to you guys to download free of charge. I really want an army of smart investors that focus on the fundamentals. There's way too many hype artists out there, especially on YouTube. Also, if you want to join a group of Patreons that I chat with every month and go through my portfolio and an analysis of the economic situation, please join us. The link is in the description. Thanks a lot for watching, and I'll see you later.